All right, good morning. Happy Monday market update. I'm Matt Gougé, Matt the Mortgage Guy. I've got Nash Paradise, the Loan Wizard. As always, we're going to review what happened in mortgage and real estate and like the week before. We're going to look forward to the week ahead. And on weeks like this, where there is a lot of stuff going on, we are very blessed to have Mr. Nash Paradise, who fights through all the minutia and all of that to let us know what we should be paying attention to, what days are going to be the most volatile. And so without further ado, Mr. Nash Paradise.
You say fights through. I actually enjoy this stuff, Matt. This is the fun stuff for me. I think the numbers are neat. Numbers are cool.
Yeah, fights through might not fit. Maybe it's just
it maybe fits with you. You know, that's fine. Yeah, and hey, I understand that not everyone loves looking at econ data and knowing what's coming up on the report. And hey, that's why we got some nice balance here. So I'm glad to be back. Missed you last week. Let's talk about what happened last week, because last week trending pretty flat. Nothing real crazy going on. We knew last week that this upcoming week was going to be the big week. So, things dipped a little bit as far as, treasury bond yields go. We saw interest rates go just a bit higher last week. 10-year yields have dropped a little and then bounced back. Honestly, there's really nothing real interesting last week to chat about. It was all pretty much chalk as far as last week is concerned. The big thing, as Matt alluded to, though, is this week. This is quite possibly the biggest week we have had for economic impact, not just data as it relates to housing and the mortgage market, but I mean overall economic impact that we have had in years, without a doubt months and a bunch of quarters, but possibly years. This is huge. So this week we're going to see, I got notes here because this is thorough and I can't read. This is too small. There's too much stuff going on. So I'm going to summarize it for you. We have the jobs report, the PCE inflation report, consumer confidence, corporate earnings, second quarter GDP. We also have the Fed meeting, and we're going to have all their stuff coming out. But honestly, more importantly than that, we have the August 1 deadline on tariffs. We got new tariff letters coming out. We've got a looming trade deal with China going on right now. This week is everything, and everything that would normally be the biggest and most significant swath of econ data ever could be completely trumped, pun intended, by what goes on with the trade letters that are going out. Now, if you didn't know, Trump is going to be sending out basically 200 letters to these different countries stating, hey, you are now going to have a tariff of 10%, maybe it's 15%, maybe it's less. The market seemed, and this is a consensus from different economists, but the market seems to be pretty comfortable in that 10, 15% range. Anything more than that, and it could throw off expectations a little bit. It's going to really depend on what we see with the PCE numbers, and that set of inflation data is coming out Thursday. So Thursday is a scary day. But, so is Wednesday. Wednesday is the Fed decision, which we don't expect Fed to move anything, but the Fed press conference is usually going to move things. There's still some core PCE prices coming out for Q2, the quarter over quarter. But then Tuesday, it's backing it up. We got JOLTS. We've got FHFA home price index. We got a 2-year note auction, 7-year note auction, all this important stuff coming on Tuesday. And you just think, hey, by the end of the week, now I can chill. Nope. The end of the week, double punch. Unemployment rate, non-farm payrolls, ISM and manufacturing PMI. Like, this is the most full week I have ever seen, at least since we've been doing this show, but I think that I've ever seen as long as I've been looking at econ data. What's your take, Matt?
Yeah, like you said, a lot of stuff. And in case anybody missed what you said, I agree 1,000% with if there is a lot of surprise or just if anything major happens with this August 1st tariff deadline, I think that washes out, any effect that PCE or the Fed talking about, for projections and Jerome Powell's, reaction to a comment or question. And so I'm interested to get your take too, just like a really simplified version so that, small public school brains like mine can understand. I heard some stuff about, over this past weekend, they're nearing talks, with the EU, and I thought I heard it like 13%. And so my brain, I'll tell you how I understand it, then you can explain it to all of us. With higher tariffs are inflationary. It's a bad thing for rates. Inflation is kind of a do not proceed with cutting rates. Rates cannot come down because inflation is not at our Fed's target. What else, I guess, when you're digging through some of this data, dancing with this data, whatever you do with this data, are you looking at, and what else impacts the stuff that we're thinking about, like where are mortgage rates headed? How's this going to affect real estate?
So that's a really good question. And you got to keep in mind, I flunked out of college, and it was music school too. So it's not like I was even going for anything hard. Speaking of public school brain, I'm the guy. Here's the thing about tariffs is tariffs, when we make something more expensive to import, we're basically saying, hey, EU, you're going to pay X amount more for our goods. Okay, cool. America, you're going to pay X amount more on these coming back, reciprocal tariffs. Neat. Here's where it doesn't necessarily have the same impact that you think. If the cost of a thing goes up, depending on what that thing is, you buy less of it. You buy fewer of them. And as that happens, the cost of a thing goes down, and the tariff winds up getting rolled back into the cost of the goods, but that revenue comes back to the U.S. now, because it's being priced according to the global market, whatever it will withstand. You look at, I've actually got something in front of me that I think is kind of neat here as it relates specifically to tariffs. So the average tax that U.S. importers pay on foreign goods has increased from 2% to 18%. So that's the money that we're paying to import things, 2% to 18%. So these things have gone up significantly, 16 percentage points. Hasn't really made any major impact. We haven't seen any major moves on year-over-year, month-over-month, or quarter-over-quarter, CPI or PCE. So they're getting absorbed. And if they're absorbed by buying less, then that will slow the economy down a little bit, which will be good for interest rates. If everyone is then spending more money to get the same stuff, that is going to be bad for inflationary reactions in the 10-year treasury bonds, which will therefore make interest rates go up. So it really depends on how far do we go. This is a scale. If you set the tariff just right, it gets absorbed, spending slows down a little bit, but you're paying more for each thing that you spend on. So there's just that balance there where, yeah, we're a little bit on the inflationary side because things are more expensive, but we're spending less money. There's less money in circulation. So then costs come down a little bit and you find that balance point. But ultimately, the U.S. gets a lot more revenue, which then puts more money directly into the pockets of U.S. citizens. And it's just a big old global currency scheme at that point. So all that to say, it could be very, very flat. As long as these things are set correctly, we'll be safe. Knowing Trump's tendency to kind of shoot the moon on his sales tactics and, go really, really high on stuff and then pull back to get it where he wanted originally, and looking at the EU stuff, it's in the teens. I couldn't remember if it was 13 or 16%. We're probably looking for a similar thing with China. I think we're going to be close to that 15% range with most countries. And I think the markets are going to at least not overreact to that. I think everything else that's happening this week is going to play a part in it as well. I mean, we're going to be setting the foundation before we get to Friday. Like I said, this week's wheels off. It could be a little bit of anything going on.
Sweet, man. I like it. That was great. Great explanation. What else we got? We got some 97% chance of hands in pockets for this week's meeting, huh?
Yeah, no one's expecting a Fed rate cut this week, which is funny. I'm just thinking back, we were thinking before it was going to be June, and then I was like, oh, it should be July. I actually think it should be July. Now should be a good time for that. I mean, the numbers don't support it, so there's no way they would. And obviously they're not going to, but I think we are waiting a little too long to start dropping these rates. This shows that in September, we're still more likely than not to see a rate cut. It's going to depend a lot of what happens the next couple of weeks. We'll see the final tariff stuff, if that, unless they kick the can down the road again, which I don't think they will. We'll have a pretty certain drop in September. We should stay the same in October. We're looking for a second rate cut in December, and not a third rate cut until March of 2026 right now. And even then, that's too far off to correctly project. It could change from there. But I think any of the discussions we had before of going like 9, 10, 12 and getting 3 rate cuts in a row, that seems highly unlikely at this point.
For sure. Yeah, let's look at interest rates, because I saw something by our mutual buddy, colleague, Tyler Hodgson, which I think was important, because I think us as loan originators, maybe real estate agents, consumers for sure, they get caught up in looking at a headline, people that are marketing lowest rates in 7 weeks, rates are exploding, and all of this, stuff. When if you go back to, you can go to early February. So we're talking 5 or 6 months of just bouncing within this small range of 6.75 to 7%. Rates are pretty darn flat for all of 25. And, what I took from that as a loan originator, as someone who talks to home buyers, future home buyers, real estate agents every single day, at a meeting I was at last Tuesday where I'm talking with a bunch of real estate agents, my thought out loud with all of them, and just for discussion purposes, was this current market we're in, this is what I would expect going forward. Don't expect anything wild to happen where rates come down, demand, skyrockets and prices jump. The kind of flat appreciation we're seeing is probably what we'll see for the next 6 to 12 months. Relatively flat, and maybe at best, we come down to mid 6s or 6.25 on interest rates is probably what you're going to see. There's plenty of opportunity and plenty of pros to the current market we're in, where some individual markets have more inventory. You're negotiating price and credits and whatnot. But I don't know. The reason I bring this up, and the reason I talked about it last week, I know the consumer. I know the conversations I'm having. People are waiting for change. And my, warning, if you're serious about buying real estate, whether it's investment or a primary residence, is don't expect anything really drastic to happen. If I was a betting man, I would bet that you could pin 3, 6, and 9 months from now and have it look relatively similar to where we are today. That's just my guess. What says you, Mr. Nash?
So that's how you feel. And the way that you feel is important. You don't know why you feel that way, but I know you feel it in your gut. I'm going to tell you why you feel that way. We have been moving towards a general consolidation in the 10-year Treasury yield right around 4.5%. As things have been more chaotic, we've seen a larger spread between, the highs and the lows on the 10-year Treasury. They are starting to come together here. So, yeah, about like that. We are moving inward. The highs are less high, the lows are less low. And we are getting to this general consolidation around 4.5% on the 10-year Treasury yield. So right now, that just means investors on every side of the books feel like there's not anything that's strong enough to justify 10-year yields being, up and over 5%. There's also nothing that's strong enough to make them think under 4%. We're not moving from that 4.5. And what that means is mortgage rates are going to be tagged real close to that 6.75. So exactly what you saw on that chart. We've moved from, a little further away to just getting more and more in. That is supported by 10-year treasury yields, by the most recent yield auctions. And until something seriously changes, there's no reason to believe we're going to see anything different than that. Now, the big fat caveat there is if there was ever a time to see something wild happen to move markets severely one way or another, it's going to be this week. This is the big week for that. So we'll see what the data does, how the numbers come out, and how the markets respond to it. But we're talking 6, 8, 9 months now in a row where we have just been hovering a little above and a little below that 4.5% yield. It's got a real tight ceiling and floor, and it's getting tighter. Like, we're not seeing much movement anywhere. There's no reason to believe that's going to change soon. But, we could throw all that out the window next week. So that's a really good reason to tune in next Monday, because based on what all happens this week, we may have some more interesting projections on how things are going to go looking forward, at least through the end of the year, as they relate directly to real estate and the mortgage market.
Cool, man. We got anything else, or is it just buckle your seatbelt, get ready for like you described? It's probably the fullest calendar of market moving data and excitement on the mortgage side that we've had all year. Any final thoughts?
That's the big takeaway. It's going to be a wild week. Monday is boring. The rest of the week, buckle your seatbelts. It's all going to have impact. So if you're holding on to stuff, like, I'm a betting guy. I love betting. I'm not betting on anything this week. There's too many things to go in too many different directions. I think ultimately we'll probably be pretty close to flat, but maybe with some more severe swings throughout the week than we're used to. So buckle your seatbelts. It's going to be a wild ride, and tune in next Monday so we can deconstruct exactly what happened.
Cool. Thanks, brother. Have a good week.
All right. Take care.